All right, let's get right into it. So many of us as traders, we obsess over finding that one perfect strategy, right? The flawless indicator. But what if the biggest edge you're looking for isn't what you trade, but when you trade it? That's exactly what we're going to crack open today. You ever have one of those days where it just feels like you're rolling the dice? I mean, you follow your rules, you see what looks like a perfect setup, you jump into a trade, and bam, the market just immediately whips against you for no reason you can see. It's super frustrating, and honestly, it's what pushes a lot of people to chase trades and over-risk, and we all know how that usually ends.
Well, here's the thing. What feels like totally random, unpredictable price action is very often just the market's natural daily rhythm. So the problem might not be your strategy at all. You could just be showing up to the party at the wrong time.
I want you to start thinking of the 24-hour market less like a nonstop, chaotic marathon and more like a global play that unfolds in three very distinct acts. And each act, well, it has its own personality, its own energy, and its own set of rules. And these three acts are, of course, named after the huge financial centers that drive them. You've got Tokyo kicking things off, then London comes in, that's the heavyweight, and it all wraps up with the big finale in New York. Understanding how each one of these behaves is absolutely key.
So first on stage is the Tokyo session. Think of this as the quiet opener. The volume is usually a lot lower, and the price action tends to just kind of consolidate, moving sideways in these predictable ranges. It's the calm before the real storm hits. And then London comes online, and everything changes. This is the trendsetter. All of a sudden, massive institutional money just floods the market. Liquidity goes through the roof, and very often the main trend for the entire day gets decided right here.
And for our final act, we get the New York session, which I like to call the volatile climax. This is when Wall Street opens its doors and joins the party. It brings in this whole second wave of huge volume, and it can either pour gasoline on the trend that London started, or it can create some pretty wild reversals.
Now here's where it gets really interesting. What happens when two of these major acts are on stage at the exact same time? Well, that leads us to what is, for most day traders, the most critical window of the entire day: the golden overlap. You might want to write this down: 8 a.m. to 12 p.m. Eastern Time. For just these 4 hours, the world's two biggest financial centers, London and New York, are both open for business. This is the market's primetime television slot.
So, why is this such a big deal? Well, during this overlap, the liquidity is absolutely astronomical, which means your trading costs, the spreads, they get razor thin. But more importantly, this is when you see the strongest, most directional moves. The market isn't messing around here. It's moving with some serious conviction.
Okay, so how do we actually use this? By understanding this daily rhythm, you can literally shift from feeling like a gambler who's just reacting to chaos to becoming a strategist who anticipates the market's flow and uses that flow to your advantage. I mean, look at the difference. The gambler's mindset has you chasing every little move all day long. But the professional, they know their window. They have a plan. They manage their risk like a hawk, often using that 1% rule, and they only step up to the plate when the odds are seriously stacked in their favor. So how do we actually adapt our trading to these different sessions? One fantastic tool for this is the average true range, or ATR. Just think of it like a volatility meter for the market. It's not going to tell you which way the price is going, but it tells you how much it's moving. So a high ATR during that London and New York overlap, totally expected. A low ATR during Tokyo, perfectly normal. And here's a really smart way to use it. Instead of just putting your stop loss at some obvious price level where, the big players might be hunting for stops, you can use the ATR. If you set your stop loss at a multiple of the current ATR, say 1.5 or 2 times its value away from your entry, your stop loss now dynamically adapts to the market's energy. This makes it way harder to get shaken out of an otherwise good trade. Ultimately, it all comes down to this really powerful idea. Pro-level trading isn't judged by the outcome of any single trade. It's about how consistently you execute your process. A profitable trade where you broke all your rules, that's actually a bad trade. A losing trade where you followed your plan to a T, that's a good trade. So I guess the question you really need to ask yourself is this: have you been fighting against the market's natural clock this whole time? Or are you ready to start trading with it? Because aligning your strategy with the market's rhythm, well, that could be the most important shift you ever make.